All right, welcome everyone. I know everyone's starting to click in. It's 9 o'clock. Thank you so much for being here. And we want to welcome you. This is Windermere's Economic Forecast with Matthew Gardner. And I couldn't help think this morning back to a year ago. And many of you that are tuning into this call right now were with us in the Walla Walla Country Club, and we were able to enjoy a great breakfast together and then hear Matthew. And, you know, when we were all sitting there together, none of us could have dreamed what last year, what was in store in 2020. And so we never imagined that we would face a pandemic and all the things that we faced. And, you know, when we went into the first lockdown order, real estate wasn't an essential business for the first few days in Washington state. And I think if I recall, the governor realized there were about 20,000 pending transactions in the state of Washington. And the governor realized we better find a way to help these people move those transactions forward. And so protocols were put in place at that time to help us work with our clients and to safely move their real estate transactions forward. And boy, did we ever get busy. And we never dreamed our real estate market would be as busy as it was. I mean, right here in Walla Walla, in the Walla Walla Valley, Milton Freewater. Matthew's going to talk a little bit about that. So we're going to get him right on. I know that's what everybody is logged in to hear. So I just want to say on behalf of the brokers and staff of Windermere, Walla Walla, and Milton Freewater, we just want to welcome you, and we're so thankful that you would tune in. I think you'll be happy that you did. So we want to get Matthew on, and to help me do that, is my good friend, Scott Wetzel. And Scott is president and CEO of Windermere Mountain West. That's the region that we find our Walla Walla Valley offices in. And Scott gives us great support to help us take good care of our clients. And we're really appreciative to that. So Scott, I appreciate what you do professionally, and you're also a very good friend. I wish you were here too. I know next year, hopefully we'll all be able to gather together once again, have a breakfast, see everybody look eyeball to eyeball, and that we'll be moved through this so that we can be together. But Scott, thanks for being here. I thought you would be the perfect person to bring Matthew Gardner on here this morning.
Well, thank you, Doug, and hello, everybody. Welcome to January. It's actually hard to believe that we're only a few days away from the first month of the year being down. And I guess it is true what they say, as you get older, time flies. And right, Matthew?
So absolutely, anyway. Yeah, great.
But I'll tell you, you know, you look at everything that went on this last year and the silver linings that go with it. You probably have heard about that so often, but one of the silver linings about us doing this Zoom presentation today is neither Matthew nor I nor Doug or even Mike Fanning are feeling the effects from the night prior, which is multiple bottles of wine. And so there is something to be said for being incredibly crisp and clear, although I think that's highly overrated, because I would have given my eye tooth just to be able to have done this last night with my my mates. But anyway, without further ado, you guys don't want to hear me talk. I want to just thank you all for your incredible efforts that you did and put forth last year in a completely tumultuous time. It really did, though, galvanize us. I think the fire got hotter, which means our swords and our spears got even stronger, and it's going to really set us up to move forward into next year. And with that, can you tell my segues when I used to be on the radio in college? Moving forward in 2021, we have a distinct pleasure and just complete respect for this individual. I give him a hard time, but he is one of my dearest and closest friends. I call him my brother from another mother. And so without further ado, I'd love, and it gives me great honor and pleasure to introduce Mr. Matthew Gardner.
Wow. Quite the introduction, Scott. Thank you. Although I could swore you said the word sword.
Sword.
Sword. Anyway, good morning, everyone. Thank you so much for taking time out of your busy schedules to come and listen to me this morning. As Doug mentioned earlier on, I think a lot of us are getting Zoom fatigue, but that's quite understandable. But even given that, thank you for coming around today. Anyway, for those of you that have heard me or seen me rather speak before, you know I like to take a top to bottom approach. We'll start out by talking about what's going on in the broader economy, broader housing market, and then really distill that down into the Walla Walla area. I cannot start without talking about this little guy. Economist's world changed a bit more than a year ago. I'll never forget, my last day in my office was Friday the 13th, believe it or not, of March. And as Doug mentioned earlier on as well, when the pandemic hit, when the governor shut things down, and I will let you know that I sit on Governor Inslee's Council of Economic Advisors, and I spent best part of 9 months on Zoom calls with him at least weekly, going through how do we reopen the economy and what's going on. I think we're doing better now, but the impacts on the overall economy are distinctly, or have been distinctly different from that of real estate. So what's going on? We can't start without looking at new infections. This is the US. We are pulling back. The blue line is a 7-day average in terms of new cases. That was to be expected. And the reason being is that it spiked when, well, everyone decided they were going to go and visit great grandma for Christmas. And because of that, we saw a massive increase in new infections. It is still pulling down, which is good. However, the new rates are staunchly well above 150,000 per day. I do think they're going to continue to trend down, but it is going to take some time. And that is going to have an impact on, you've got it, the US economy. Numbers came out this morning, and I was up in the middle of the night putting or changing these slides to put them together. We got the fourth quarter growth. It was 4%. My forecast was 3.6, pretty close, so it was good. However, year over year, if you look at 2020, the biggest drop in about 72 years. But what I want you to take away from this are two things. One, the second quarter of last year, biggest contraction in history, followed by the biggest expansion in history. But we have pulled back, it was still certainly above the long-term average, to a more reasonable single-digit number. But I want you to look to the right-hand side of the chart, and it basically suggests that growth is going to accelerate this year, likely in the second half of the year. Now, why is that? Well, it's going to be because of vaccines. Once we get a full, complete rollout of a vaccine inoculation, whatever you want to call it, and we decide to take it, I think we're going to start going back out in public again. We're going to start spending money. 70% of the US economy is consumption, and that's going to drive certainly a lot of economic growth going forward, but it is more than likely going to come in the second half. From the employment perspective, this is month over month employment changes. Last month, December, horrendous. I was expecting a maybe 30, 40,000 job increase. We saw a drop of 140,000 jobs. But what was going on there was a bit interesting. It was massively affected by leisure and hospitality, bars, restaurants, hotels that shed another 500,000 jobs. But on the other end of the spectrum, you can see on the top, a lot of industry sectors are still doing remarkably well. They are adding on new jobs. So the recovery, both economically, certainly from a job standpoint, it's very bifurcated. It's very much the haves and the have-nots. But on that last slide I showed you, showing a massive drop we saw because of COVID when it initially kicked in. This gives you a bit of a better idea. From the fall of 2010 to early 2020, the US added a bit more than 22 million jobs. We lost more than that in 2 months. I mean, this really was quite extraordinary. But you do see the snapback, the growth kept starting in May, but the growth, as I suggested earlier, has started to taper. Now, what do I think is going to happen? Well, there's several things, but when we look at the different makeup of jobs, naturally those industries that are more face-to-face are suffering more. Worst off is leisure and hospitality, lost almost 8.5 million jobs in a couple of months, but has got 4.5 million of those jobs back. So you can see that many industry sectors are doing a lot better. Certainly we're far away from getting back to a full recovery, but the number of jobs lost in professional services sectors has been considerably less. And I say that, and I know it, because I don't know anyone that lost their jobs. I don't know anyone that was laid off. Yes, we are all working from home, but we are still working. So it kind of really defines the shape of that recovery. Some sectors are doing significantly better than others. When we look going forward, quarterly, I need to probably explain this. So if you look at the fourth quarter, that 283,000 number, that meant that we added an average of 283,000 jobs per month in the quarter. A decent number. We historically average about 200. Certainly a lot better than losing an average of 4.4 million in the second quarter of last year. But again, as you can see, going forward, we will see faster jobs coming back once we get the vaccine out, once we get the inoculation out, and a majority of us are taking it. On the unemployment standpoint, you look at the 6.7 in December, as anticipated, certainly higher than I want to see it. But I want you to look at the light blue line. That's the real unemployment rate. Still just shy of 12%, well higher than I'd like to see it. I'd like to see that in the mid to high single digits. Now, for those of you that are unaware with this particular way of measuring unemployment, the dark blue line, the one we all talk about, the U3 report, it includes people who are out of work and who have actively looked for a job in the last 4 weeks. The light blue line, people are out of work, they want another job, but they haven't actively looked. So it's the real unemployment rate. Still elevated, but certainly a lot better than we were back in April. The last time we saw a figure in that 23, 24% range, well, that was back in the Great Depression. So we are doing better, but the improvement certainly has started to slow. And that's going to be a sign going forward. Unemployment rate in the fourth quarter, 6.7. It is going to trend down, but it is going to be a long time before we get down to that number below 4%. We're certainly not going to do it this year. And I mentioned how the bifurcation of the economy is with the haves and the have-nots. We look at the shape of a recovery. And this one, believe it or not, is K-shaped. Many of you might have heard about the V-shaped economy, and that is certainly true in certain sectors. And then sometimes you have a U where you drop down, hang around for a while before improving. You have the dreaded L where you drop and you never come back. But people came up with a new one, the Nike swoosh shaped, very sharp down and then a gradual recovery. But it depends on what sector you're in. As Scott and as actually Doug mentioned earlier on, housing, we are remarkably lucky. Absolutely a super V. We took a few days off. So yes, we lost for the better part of most of the spring market. That became a summer market, continued through the fall. You guys have all been remarkably busy. And why have you been busy and many other industry sectors haven't? Well, again, it depends on who your clients are. Most of the people buying houses, they are still working. And with mortgage rates dropping, I'll talk about that a little later on, and a lot of people deciding to move because of COVID-19, real estate got busy. Online sales, obviously, thank you, Amazon.com, who are doing remarkably well, certainly up here. We are spending more money online, naturally. But most other sectors, sharp down, gradual improvement. Now, how has this not impacted housing? Well, it has, but it's impacted apartment housing far more than ownership housing. And I will say one thing, because I did forget when I started, and I apologize. If you do have any questions, if you type it into the question and answer box at the bottom of your screen, Doug will moderate that, and we'll get to those questions at the end. So I'm sorry for not mentioning that a few minutes ago. All right, so what do I think about the country as a whole? Yeah, most economists, certainly myself, significant weight on not just a successful distribution. Interesting to see the Biden administration now reaching out to Microsoft, reaching out to Amazon to help them with some of those logistical issues that there are out there. And most of my forecasts certainly presume, one, we will get a rollout sometime in the late spring, early summer, and two, most of us will take it. That's going to be remarkably important, because if we don't, then certainly the economy cannot grow. Not all jobs will come back. And a lot of the jobs that were lost in those face-to-face industries won't. And here's a reasonable example of that. Imagine once we reopen, you decide you want to go and stay in your favorite hotel. You're going to see some things that are going to be very likely very different. Front of house, where you check in, probably going to be not there anymore. As you walk through the door, a key will appear on your phone and off you go. Food and beverage services, again, going to be substantially pulled back. And why I mentioned this is that people that were in those jobs, well, they're going to have to figure out something else to do if those jobs do not come back. And also Main Street retail. Now, retail is getting better. I will tell you one thing, hopefully all of you can, and that is where safe, where allowable, please go and spend some money in your local retailers. They are hurting. and they are a very, very big component of the overall economy. And unless we can get them back, it's going to be very, very hard. So because people will have to retrain, that's going to hold the unemployment rate a bit higher than I would like to see, but it will trend down. Legislative initiatives to help in the recovery. Now, this is true. Some of you know the Biden administration wants to implement a big infrastructure program, bridges, roads, this kind of thing. And I commend them for it, but it's going to be still very, very difficult to get that kind of legislation, big legislation through. However, if they can, at least in part, that will certainly help. And yeah, better part, we'll see most recovery, well, not most, a faster recovery is going to come this year, but it is going to come in the second half. All right, so that's the US economy. What about the US housing market? We'll start out with existing home sales. There's nothing to buy. I mean, quite literally. We have inventory levels now just in north of about 1.2 million. That's horrendous. The long-term average going back to the late 1960s is just shy of 2.5 million homes on the market. So very, very tight. We have seen supply remarkably, remarkably low. And because we've seen it low, pending home sales, this again talks to what Doug mentioned. Yes, you did drop down very briefly, but the snapback was remarkable. However, you can see fewer contracts signed towards the latter part of the year. What was going on? It was purely an inventory issue. There's just not enough houses out there to meet demand. Now, what happens when you see, or when you have more demand than you have supply? That's right. The market gets very, very competitive. The average number of offers per sale in December, 3.5. That is insane. So on average in America, 3.5 offers on every sale. That is extraordinary. Because it is so competitive and it is such a tight market, what's happening to prices? You've got it. The average sale price in December was up almost 13% year over year. That's remarkable. I wouldn't say it's on an all-time high, but it is pretty darn close to it. We saw that kind of level back in around 2011, 2012. Why? Well, with the housing bubble burst, housing prices dropped. In fact, they overcorrected on the downside, made houses actually rather cheap. And that meant we saw prices leap fairly significantly. Now, we have pulled back over the last couple of months, but still well above the long-term average. Now, here's what's going to change a little bit. We are going to see, I believe, more transactions this year than we saw last year, certainly, and more transactions we've seen since 2006. Really, it's an amazing thing. I was actually chatting, I was giving a speech with Lawrence Young, the chief economist of the National Association of Realtors, and both of us agreed that that 2020 number of about 5.6 million, that could easily have been 7 million if we had more homes to buy. Trouble is, we don't. But we are going to see an increase. So what's going on with that increase? We are going to continue to see more people moving because of COVID-19. And when I say that, there's several reasons why. One of which is people will look, if they are allowed to work remotely, to cheaper markets where they can get more bang for the buck. I'm here in Seattle. We certainly are seeing that already. So we're going to see some more turnover because of that. Additionally, people will move if they can work from home. But some of them are actually going to move because maybe they don't have a dedicated workspace in their homes. I don't. Believe it or not, I'm working from my dining room table right now. Not that you can tell, but a lot of people don't have an office and therefore they're going to move in order to find a home that is better suitable for their needs. And finally, people will move because they're bored. I have looked at the same four walls for the last 10 months. I've spent more time in my home since March than I've probably spent in it since 2014. And what do we do when we look at anything too much? We get bored. And so I think some people will look around and say, you know, my living room, don't really like it. My kitchen's not big enough. And I think we'll see them moving as well. So in terms of turnover, sales of existing homes, those I believe are going to pick up significantly. There is something else you need to think about as well, and that is home price growth. It is going to drop. We hit 9% last year. Extraordinary number, highest number since 2013. And as I mentioned to you earlier on, that was because we were coming out from following the burst of the housing bubble. So it's going to be a lot lower. And what's going on there? I think we will see some more supply. I think new construction, which I'll talk about in a minute, is going to pick up. That is going to take some of those demand pressures away from existing homes. But there's one thing which is going to come into play more than anything else, and it is this: mortgage rates. So what's going on with rates? So I pulled the numbers this morning before this speech. A couple of things I want you to look at, one of which is the relative advantage of an adjustable rate mortgage over a fixed rate mortgage doesn't exist anymore. That is amazing. Moreover, we're looking now at 30-year fixed, 2.73%. I mean, that is really quite remarkable. 15-year down at 2.2. Now, you might note those spikes, certainly the major spike you saw in the 5-1 arm. And a couple of weeks ago, we saw a fairly significant jump in mortgage rates, very briefly. And what was going on there? Well, it was caused by the bond market. And for those of you that aren't aware, the bond market actually drives mortgage rate movements. Bonds sold off aggressively. What was going on? Well, the Georgia Senate elections happened. And that sparked the move because when Democrats won both those seats, it gave them total control of the government, therefore potentially easier to pass more legislation, certainly as it pertains to another round of COVID relief stimulus. So with that happens, what goes on is that people come out of bonds into stocks. That means the bond price has to drop, the yield, the interest rate has to go up. That affects mortgage rates. So nothing to worry about, but part of the reason why we saw that massive increase in sale prices last year was because over the last 12 months, the average 30-year fixed rate mortgage has dropped by 1 full percentage point. That was amazing. So as rates drop down, even if we didn't see income growth, at least significant income growth last year, that still allowed people to spend money and more money on housing. Remember, for every 1 percentage point drop in mortgage rates, a buyer can afford to buy 10% more house. It's the 1 in 10 rule. Now, this might sound great to all of you, and it is, but I'm an economist. I try and find the dark side of the force. And what's going on there is this. I've got a friend of mine who works for Fannie Mae. He sends me some great data sets. And this looks at people who refinanced and how much it lowered their mortgage rate. Third quarter, we haven't got Q4 numbers yet, but people who refinanced in the third quarter reduced their mortgage rate by an average of 28%. What did that mean? Well, that meant essentially going down from a 4% mortgage to a 2.9% mortgage. Now that's has already provided significant savings for households, about $2,000. This is across the country, by the way, over the first year, about $10,000 in savings along the life of the loan. But here's my concern. It's not now, it's not this year, next year, maybe not even the year after. I want you to put yourself in your homes and it's 2025. And mortgage rates are likely normalized at 5.5 to maybe 6%. And you are sat on your 2.8% mortgage. Are you going to move? I think a lot of people won't. That could be a problem. Again, not in the next couple of years, longer term, because people aren't going to want to lose those historically low rates that are very likely never to be seen again. And there's another reason why I think we'll see home price growth slow. This is my forecast for mortgage rates through the course of this year by quarter. Yes, they're going to rise, but the increase is going to be very, very modest. However, any increase at all certainly can act as a bit of an anchor, a bit of a headwind to home price appreciation. And if you think, well, you know, Gardner, yes, he's right most of the time, but maybe not all the time. Maybe he's wrong on mortgage rates. Well, every week I have an interesting happy hour with some friends of mine. And my friends work for different groups. Actually, they work for all of this lot. And we exchange notes on what's going on and what we feel our mortgage rate is going to be. Right now, by the way, the butt of our humor are actually my friends over at Fannie Mae. They think the average 30-year fixed, well, it'll average 2.7% this year. Don't see it. But Fannie and Freddie still below 3. I'm in at 3.2. NAR, Wells a bit below that. Mortgage bankers, normally very dismal. They are the most aggressive in terms of an increase, but even they are looking at 3.4%. So yes, rates going to rise, but the consensus is they're really not going to rise by that much if you X out Fannie and Freddie. I probably get asked more by our brokers in Washington State and agents across the country about forbearance more than anything else. Now, forbearance is interesting. And so very quickly, forbearance, a program implemented back in April because of COVID-19. It allowed people to defer making their mortgage payments if they'd lost their job or if they'd been furloughed. Now, it doesn't mean those payments go away. You still owe that money, but it means you're not going to be foreclosed on. When that happened, a lot of people, you can clearly see, jumped in. We were well north of 4.5 million homeowners in forbearance, but it has dropped significantly. We're down by 43%. That said, there are still, according to Black Knight, 5.2% of all homeowners in forbearance. If you believe the MBA, it's about 5.4. But the worry is that when forbearance ends, it's supposed to end, by the way, end of March, but I believe the administration will actually extend that further. But people will still be out of work, won't be able to afford to make those payments. They're going to be foreclosed on. We'll see a tsunami of foreclosures, more listings, more supply. What does that do to prices? Makes them drop. It's not going to happen. A couple of reasons why. One of which is still a lot of people in forbearance are still paying their mortgage. Secondly, I think a lot of people will be able to refinance their loan and therefore not be foreclosed on. And finally, banks are more enthusiastic when it comes to working with their clients now than they were back in 2008. They don't want them to lose their homes. So when you combine all those things, I think that most people are certainly not going to go into foreclosure. My forecast right now is for new foreclosures starts this year, probably around 500,000. That might sound like a lot, but it's really the long-term average. But finally, even if people can't refi and they can't get out, what are they going to do? Most of them are going to sell. And we know there is a lot of demand out there. And because they don't want to lose the equity. 80% of people in forbearance have 20% or more equity in their homes. That's a very, very significant number. And so ultimately, yes, I think it's a good program, but more importantly, it's not going to be something which is going to drive another flood of listings and another kind of version of the bursting, or what we saw following the bursting of the housing bubble. On the new home side, numbers again came out this morning. Massive increase in permits. Look at that spike. Again, housing remarkable, dropped down precipitously, but new permits have been very, very significant coming out of that point in time, annualized over 1.2 million. And that has led to what? New home starts have increased as well. And that's a good thing. So I see those starts going up, we need to see more supply, and more supply is going to be very, very important. Why? Well, the number of homes on the market, yes, it's got better as more starts, more homes went under construction, but it's still well below the levels that are needed, just given new household formations. And if we're not seeing enough new construction, yet we're creating a lot of owner households, that puts more attention, more focus on resale houses, and therefore that pushes prices up. And sales put off, dropped down. However, they have stabilized a little bit, but that was only purely due to a lack of supply as opposed to anything else. But what we are going to see is sales jump. We should hit about 1 million, just shy of about 988,000 new home transactions. Single family will occur this year. Builders are doing a couple of things. One, they're enthusiastic about housing in general, about housing demand. Two, they're looking at other markets now where potentially land is cheaper because people are moving away from the core business centers. They've still got some issues on cost. We know that it's very expensive to build a home, but they are going to try and address post-COVID needs. Open floor plans, they're not doing those anymore. People want that room separation because of COVID. There are also home sizes which have been shrinking for the last 7 or 8 years. Builders are now building bigger, again, because of COVID. So I think that they're looking to attract a lot of the buyers they believe are going to be out there. That's going to drive sales higher. But again, more supply is going to take some of that pressure off existing inventory. And why are people deciding to move? I thought this was fun. A survey that Unigroup did. The number one reason why people moved last year, their own personal health and well-being. Number two, close to the family. But number three, the big one for me, change in employment status. People's ability to move away from the urban centers into more suburban markets. I'm not saying everyone's going to hoof off to the wild blue yonder, but a lot of people are going to stay relatively close to where their jobs are, but they can move further out. That's a big thing. And also lifestyle. That applies to your market very specifically. So a lot of the reasons why people are looking at other markets now is because of COVID. Not for the fact that we are going to get through it. We will. But I was listening to Bill Gates this morning, and he was saying, we need to prepare for more of these things to occur. We are going to see more pandemics in time. We need to manage it as one would do in preparations almost for a war. So I think that we're going to see those things, and people, because of that, are going to start to look to other markets that historically they may well not have looked at. Also, we're going to find apartment dwellers, renters, are going to become homeowners again because they can move further out. And I will cite a very good example. My eldest son, Aaron, 30 years old, got married a year ago. Both he and his wife work for Amazon. They were paying some unconscionable amount of money here in Seattle to rent an apartment. Well, they were both told by Amazon, you don't ever have to come back to an office again. So what do? Well, they got out of their lease. They went down to Multnomah County outside of Portland, and they bought a home. And their mortgage that they pay every month is significantly lower than their rent. First-time buyers is going to be a massive, massive player in the market, I think, going forward, for not just the fact they can live elsewhere, but just because there's demand. And I'll talk more about that momentarily. Some policy changes that could impact housing. First one, again, it's going to help those renters. The Biden administration wants to implement a new $15,000 tax break for first-time buyers. We've had these before. We had them when we came out of the bursting of the housing bubble. Believe it or not, we also had a similar plans were in place both under the Bush and the Clinton administration. The difference is here, rather than waiting for your taxes, tax returns to be filed, you can get that money earlier. So you can immediately use those funds. More role for the FHA. That means certainly on the lower income households, minority households, if they become a greater player in the mortgage world for these people, that is going to again increase demand. Also possibly reducing mortgage insurance premiums. That again is going to drive some of that demand, not just from first-time buyers, but also from lower income households. Some help for builders, possibly. They're looking to change zoning, potentially, to add density in many markets. That's going to be important. Many markets, we're running out of dirt, quite frankly. And there's one other plan they have, and that is to ease the regulatory burden. Builders they are just hit left, right, and center. They have one job they want to do, it's build a home. So there's so much regulation involved in home construction. So maybe some easing of that would help. Now, these things aren't in place now. They need to pass obviously through Congress. If they do, however, certainly it's not going to be a negative for housing. Housing is going to be great with or without this. It just could become even better. The big picture, demographics, think first-time buyers. I think that's going to drive a lot of demand from apartment owners. Also, we're going to see demand from people because they can build, or rather, they can work from home. New construction is going to rise. That is going to take some of the price pressures off the existing home inventory. Yeah, we are going to move, and a lot of us. I mean, not all of us, but a lot of people will. That means you are likely, you will be busier this year than you were last year. There's going to be more movers. And finally, first-time buyer demand. It's going to be massive. So in all the housing market, yeah, we're going to see a slowing down in price growth. I love it. It's important. I hate markets that go up by 8, 10, 12% per year. They're not sustainable. So slowing down there, but ultimately more transactions this year than we've seen in, quite frankly, 15 years. All right, looking now at your world. Starting off with Washington State, this is new COVID infections. Again, similar picture, trending down. It is getting better. I mentioned earlier that I sit on Governor Inslee's Council of Advisors. And for most of last year in these kind of speeches and discussions with our brokers and our owners, I was saying the same thing. And that is, if the numbers go up, Governor Inslee will pull us back down again. And he did. And we slowed down. However, we have to turn that corner. That's a positive. I'm very hopeful that will continue, which means we are likely to come out from under COVID, I would argue, a bit quicker than the country as a whole. And if we look at Walla Walla new infection rates, yeah, certainly a drop over the course of the last couple of weeks. Massive spike you saw through the fall. Unsurprising, but again, if you think about absolute numbers, not that huge. But the trend's going in the right direction. So bear with me, keep on wearing your masks, keep on social distancing. That's going to be very important. Really, when you talked about us coming out and getting back to our normal lives. The employment situation over the last 12 months, naturally, unsurprisingly, dropped. But again, it's a very small economy. But what I found wonderful, look at that construction employment. You added 200 new construction jobs in over the last 12 months. But again, it's very difficult to compare what was going on December of 2019 versus December of 2020. So 2019 was great. Nothing really bad was going on until March. So what you need to think about it is more like this. The dark blue bars signify the jobs that were lost in the couple of months due to COVID. The light blue, the job recovery. So you lost 1,000 jobs in leisure and hospitality, but you've got half of those back so far. Got most of the jobs back, or 2/3 in education and health services. Manufacturing is net positive. Not so much in retail. Government's contraction, again, they tend to walk to the beat of their own drum. Construction didn't lose any jobs, which is good, but no change. Well, no growth in financial activity. You lost about 100 jobs, not a big component. Zero change in information. So what does this mean? Again, it does demonstrate that jobs that are more face-to-face suffered more, but you are also seeing those jobs come back. And that's going to continue. And I think that we will see growth in manufacturing. I think we'll see growth, further growth in construction, further recovery in leisure and hospitality. So what does that mean from a forecast perspective? Lost about 800 jobs because of COVID. You'll be adding back about 400 jobs of those will return this year. So it's going to be on the average, but again, most of that growth or that recovery is again going to come in the second half. From the unemployment perspective, it's unemployment numbers we get from the state, and they haven't come out with December's yet, in case you're wondering. Still elevated. It did notch up a little bit, and you might be a bit concerned about this, but I'm not. I reached out to the state economist to say, because a lot of markets saw a spike, mainly in the labor force, and they said that they had some issues with some of the full numbers last year that will be corrected, but that correction won't come through until probably March. So what does that mean? It means take the November number with a pinch of salt, and it wouldn't surprise me to see the December number when it comes out be higher still. So it's going to be okay. It's mainly re-benchmarking, but the unemployment rate is certainly better than almost 12% that we saw. As we go forward, as those jobs return, you're going to drop down this year, likely ending 2021 somewhere in the low fives. I don't think you're going to get to 4, but I think the low 5 market is going to be likely where you will be by this time next year. I also like to look at population. It's important, certainly from a housing standpoint. Now, what is I found fascinating here, the light blue line, that's the normalized growth. That takes basically the number of people living in Walla Walla, births minus deaths. So if one's going to offset the other, obviously, and you haven't really seen any organic growth. But what you have seen for the last 4 years, significant net migration, people moving in to your market from somewhere else. And that's a positive. And that, I think, is something which is also going to continue. And again, because of the fact of COVID-19, of remote working, of the lifestyle. Doug mentioned earlier, I love going out, although I do have a bit of a hangover generally when I finish with him. He takes me to some great wineries. The wine industry is naturally massive in your neck of the woods. So I think you're going to see more of that. I also potentially, as you see a return in tourism, that is going to increase that job market as well. So I think most of your growth really is going to be coming from people moving into your market as opposed to new people being born. Regionally, yeah, it's uncertain. Again, we all economists, and my liver is killing me right now because we just don't know. We believe or we hope that we'll get the vaccine, we'll take it, everything's going to be good, we will reopen. So all my forecasts certainly do presume that is going to be the case. So we lost a lot of jobs, a lot have been recovered. That is in turn a positive. For recovery, we won't get all those jobs back until 2022, but again, you are clearly on the way there, which is again great. And manufacturing, education, healthcare, construction. I think those can be the 3 industry sectors that are going to lead the charge when it comes out. A fourth, if we get reopened sooner rather than later, may well be that leisure and hospitality market. But again, it's not a massive component of your economy, but it could only be a bonus if we start seeing improvements sooner rather than later. Now, finally, the thing you want to talk about, first and for this, I need to do a bit of a hat tip to my dear friend, Mindy. And I say this because your little MLS system changed. You got absorbed by the powers at the Northwest Multiple. That made getting some data rather hard. Mindy stepped up to the plate, gave me some remarkable information for me to incorporate into my slides here. So Mindy, thank you. All right, so How long are you living in your homes? You live on average about just shy of 6 years in Walla Walla. That is a number which I believe is going to increase very significantly. It's been on the rise since, well, for the last decade, just shy of that. That is going to increase. And the trouble is, if you live in your homes longer, that means you don't get that turnover of homeowners. That's a problem, again, when it comes to supply. And here's why it's important. Listing activity. Now, I take Mindy's numbers and I adjust them for seasonality, which is otherwise it kind of looks like my heartbeat. It's got a big sine curve, right? When the market's hot, summers and winters. So this kind of smooths that out, but inventory levels are horrendous. And if you look at the 12-month change, which is not seasonally adjusted because you don't need to if you're looking at the last 12 months, 56% lower level of inventory. Now, this can be a bit confusing for some because sales have been going up and we know that. So what's going on there? Well, it's the way the numbers are calculated. Listing inventory is taken as the number of homes on the market on the final day of the month. Yet sales are sales throughout the entire month. What happens if you see a lot more transactions? That means that new listings that came on were selling in that 1 month period, turning pending, and therefore they don't actually count against that final end of month number. So it's just the way they balance the numbers. But bottom line is inventory levels are still very low, but sales activity, and I put in a trend line here going back, has certainly seen a significant uptick. In the fourth quarter of this year, more sales we saw, actually the same in the third quarter of 2016. So sales on a quarterly basis certainly picked up massively. That drop in the second quarter, not really surprising. Why? COVID, the inability to sell homes briefly, but the pickup has been quite remarkable. And because of that, look at that year-over-year change in sale price, almost 30% for single family homes. That is extraordinary. And if you look at the trend of it, yeah, I mean, you broke through $400,000 at the average sales price in December. What I found, a couple of things are interesting here because you broke through 400. On average, somebody that bought their home in your market in 2012 has seen their home price double. Now, I don't know where else you could go to get that kind of return. It really has been amazing. But at some point, it has to start to slow. But another reason why you're seeing a lot of transactions, and this is an interesting way to look at it, I kind of break down the market, and this was sales in 2020 by price ranges. And by far, the biggest cohort is actually in that 3 to 350, or 20% of sales came in there. That is still relative to many markets a very low figure, relatively speaking. And so where you still have essentially housing, well, affordable housing, that is a positive. And that's where we're going to expect to see it. But we have seen a change. We've seen a drop down in that 2 to 250 in 2020 versus 2019, unsurprisingly, as prices rose. So price growth is still fundamentally in that core, well-priced market. And I think that's what you're going to continue to see as we move forward. On sales by year, well above the long-term average, which is about 650 units. Again, I X out new construction, but a very, very significant figure. So it's happening. You have become very busy. I know that when COVID-19 hit, everyone was worried about the housing market is going to collapse. It didn't. It took a weekend off, and that was really it. But you do need to see more supply. And I say that because you got less than 3 months of inventory. A balanced housing market should be somewhere around 4.5, I would suggest. Nationally, people say somewhere between 4 and 6. It varies by market. So if you think about it in those terms, it is still tight. And in fact, if you look at the fall of last year, well below that 2.9 figure, 2.9 was actually the average for the year. So when we talk about housing, is there housing demand? Absolutely, there is. Is there supply? Well, I'll talk more about supply in a couple of minutes. But in terms of the existing inventory, really, there isn't. It's very tight. And because of that, prices jumped. The average price up by 13.5% last year. My forecast for this year, still a very, very solid 7.5%. Well above the nation, well above many markets, certainly more than we'll see up here in Seattle. So good growth. However, here's a couple of things, and certainly if you represent home sellers, as I hope to have explained to you, have done very well this year. And they think their home is worth, sky's the limit. And for a while, they kind of got away with that. There go the 13.5% growth last year. But as we go forward, if we don't see the income growth, we are likely to see very modest income growth, probably around inflation this year. And we're seeing modestly rising mortgage rates. Both those things suggest we have to start pulling back a little bit, but it's still going to be very significant. From the new construction standpoint, unfortunately, Walla Walla only reports annually. They haven't yet reported 2020. 160 permits, lower than 2018, but you are building, which is a good thing. And if we talk about ongoing demand, there's about over 14,000 homeowner households in the county. My forecast, that's going to grow by about 4.5%. That means you'll have demand for new homes of about 653 units. Now, it's going to be, if I am going to be wrong on this, I'm going to be wrong on the low side because of the fact that census numbers haven't come out yet for 2020. So once we see those, I will be adjusting this, because what could happen if we do see, and it wouldn't surprise me, people moving into your market from elsewhere, maybe they're coming in from Portland, maybe they're coming in from Seattle or wherever, that number could increase. But there's one more component as well, and it's these guys. They're millennials. And just very briefly, who are millennials? Well, they're the biggest demographic by number than any other. But here's a better way of looking at it. This looks at millennials and Gen Xers by the year they were born and how old they are this year in the bottom. So we haven't seen a peak of millennials turning 30 yet. The median age of a first-time buyer is 31. So going forward, as they start creating these real relationships, getting married, as my eldest son did, having kids, I'm going to be a grandpa later on this year. Don't even want to think about it. Anyway, that suggests to me that they are going to turn into buyers. So we're going to see a lot more demand, I believe, from millennials than they are going to be first-time buyers. So I went back and looked at sales in 2020 in Washington State and what share of sales using conventional financing, Fannie or Freddie, were to millennials. And in your market, it was 55%, a huge number. Higher in Kennewick, even higher in Yakima, believe it or not. I mean, your wine's better than theirs, but whatever. So, but even up in Spokane, well above half. So that we see that there is a lot of demand from these millennials. If you're a broker listening to this or watching this, working with first-time buyers, perhaps you want to think about it, because they are out there. And who do these strange people look like? Well, I probably shouldn't say strange. I apologize, any millennials watching. 50% were male, 43% for female. I know that doesn't make 100. That is the world in which we live today. About half were married. That makes sense. Double income, potentially no kids. They were on that average age in terms, US average 31 years or median. So about 31 years old. They borrowed about $223,000. They bought a home price just below 300. So we go back to that triangle, that pyramid chart I showed you. They are on the lower end of that spectrum, but they are going to be there. They put 22% down. Very impressive. And it really is. A couple of things. One, half are going, more than half are going to the bank of mum and dad, saying, I think I need to become a homeowner. Please help. But the other half are actually saving up themselves. So that, I think, is an extraordinary figure. You expect to see it be a lot lower. But it's this final one I want you to look at. They've got credit. So all of you that are so adroitly, smartly, when you sent your kids off to college, gave them a bright, shiny American Express card that you co-sponsored, but woe betide the child that doesn't make the payments. The good thing about it is they were building their credit up earlier. They've got credit. So it's not a case that they're buying just because they want to and they still can't afford it. They can. Significant down payments. Also, they've got significant credit. So locally, I don't think we'll see a massive increase in supply. That means it's going to hold prices higher and price growth potentially, but that ceiling is going to be there relative to affordability. As I said earlier, price growth will slow. Watch first-time buyers. Demand is going to be very robust. Work with them if you can, because they're out there. They might be a bit painful to work with, as in if they text you at 11 o'clock, they expect a reply. And secondly, if you text them, don't put a period at the end of the text. They think you're angry with them. Go figure. Anyway, so that's going on with those guys. But finally, no decline. I think you are going to be busier this year than you were last year. I expect to see transactional velocities increase this year over last year, fairly modestly. And in closing, I will tell you this. COVID-19 certainly hit the economy locally, nationally, significantly so. Housing probably out of any business class, asset class, has performed remarkably well. And COVID-19 is only going to exacerbate that. So a lot of people will choose to move because of not just this pandemic, potential future ones. First-time buyer demand, very robust, very, very significant. They're going to be there. New construction nationally is picking up a little bit locally, but that might be an underestimate depending on how we see more fallout occurring out of COVID. But the market is going to be positive. Prices will continue to rise this year at above average rates. And with that, thank you for inviting me. Doug, I'm not sure if you want me to hand it back to you or whether we'll just and shut the screen down.
Well, yeah, so no, just you can keep that screen shot up, and okay. We'll watch for any questions anyone may have. They can put it into the box. There is one, and that's about income properties. We have a lot of people on the phone that own some income properties.
Yeah.
And I heard you mention, you might have alluded to it a little bit in your talk today, but the difference between owning an income property in a smaller community like Walla Walla versus owning an income property right now in a large metropolitan area. You know, I think you mentioned lots of construction of apartment units hitting the markets. That maybe it's, I guess, what's the difference right now as you project income property ownership in a large metropolitan area versus one like Walla Walla?
Okay, well, several things to talk about here. One, which is you're right, we're going to add on probably 400,000 apartment units in America this year. And these owners of these massive apartment towers in our urban markets, they are going to be suffering significantly this year. But they'll be fine. What's going to happen is that if you invest in a real estate investment trust, for example, Avalon Bay or Equity Residential, their yields, their returns are going to be horrible. And on top of that, we have this moratoria on evictions. You cannot throw people out. That's a problem. That moratoria, again, could be extended further. That's going to make it hard for them. On the single family apartment or rental market, a couple of things also worthwhile mentioning. One of which is, certainly we found people, they have this income property. They might have lost their tenant because they had a job loss or a furloughed, and they obviously have got a mortgage, most of them, on that home. Well, you can get forbearance on a, it doesn't have to be a principal primary residence, on a second home. You can get it on an income property. So we haven't seen a big fallout on that side yet. But I think the difference is going to be that we'll find housing markets where home prices are so significant means that the rental rates have to be very high to cover that debt. And that doesn't apply in markets, for example, where you are, where it's a lot lower. If you have an income property, hopefully you have a tenant in there. Hopefully they're still paying you rent. I know that there are still concerns over moratoria there as well. But is it a time to get out? Now, I think we will see that move away from the urban markets that you alluded to, Doug, further out. So I think the impact's going to hit the urban apartment world. What that's going to mean is that we'll see apartment rents drop to increase occupancy. That is going to impact, I believe, the people who are on the periphery who might want to be still closer to their workplace, but couldn't afford it before. Now maybe they can. Less of an impact in your world. So if you've got a tenant in there, that's great. I think rental rates likely will be modestly higher to flat this year. Wouldn't surprise me, because again, we're not going to see that income growth. And it's going to be important, I think, for landlords, if they have a tenant in there that's paying you, to keep them in there where at all possible. But we're also not going to see a big fallout, as I mentioned earlier, through tenants not paying and therefore landlords not being able to pay the mortgage and being foreclosed on. Don't see that occurring.
Well, thank you so much. So I'm just looking here. I'm not seeing more questions.
It's quite remarkable
at this moment. And I want to chalk that up to you doing such a great job presenting your material that there's nothing left to question. But thanks again. Oh, I see a couple here. Let's
now I can. With the eviction moratoria, Todd, the eviction moratoria in place, are there any stats on how many LL, not quite sure what LL means, have had to sell, landlords have had to sell due to tenants not paying rent? And has this reduced the number of landlords willing to invest? Todd, I'd love to be able to say I know that answer that question. I don't. What I would say is I'm sure Doug or somebody down there would have a better idea, but I don't. I'd be the number of jobs. So the recovery has been fairly robust, so I don't expect to see a mass amount of empty single-family homes of investors. But you said it's right. The moratorium on evictions is in place and is going to continue, but I don't think we've seen that much of a fallout thus far. But again, I wish I could answer you, but I don't know where you could dig into those numbers. I'm sure somebody can. And Susan, is it likely that smaller multi-unit buildings like quadplexes appear and increase? Great question, Susan. And I am very enthusiastic about this kind of thing. Why do I say that? We know that in many markets that we are land constrained. Even if you're not in Seattle where we have mountains and water, we still have urban growth boundaries around all counties in the state. And you can build inside those counties, and outside them, it's 1 house per 5 acres, up to 1 house per 20 acres. So what does this mean? Well, what we saw occur about 1.5 years ago in Minneapolis, Minnesota, Minneapolis said, okay, we will allow people, or developers, builders, to build duplexes, triplexes, 4-packs inside any current existing single-family zoned area to add density. I think it was smart. Now, it's going to take a while to roll that out, but following that, what happened? The state of Oregon adopted an identical policy. Now, it doesn't come into play yet. Outside of metropolitan statistical areas, it kicks in as of May of this year, and it's May of 22 inside MSAs. So if they do it, it wouldn't surprise me here in Washington State, and certainly all the discussions I have with state senators, which I happen have scarily frequently, is I'm really trying to push this kind of proposal to be implemented. So I think that we could see more of them, but the problem is, if it means tearing down an existing single family home to build a multifamily dwelling on it, well, the value of the land underneath that existing house has got to be higher than the value of the house on it. Otherwise, it doesn't make sense financially. So that it's not going to be a panacea, but I think we will see more interest in that kind of product going forward. And certainly we know that there's developer interest in building it. So I think that it wouldn't surprise me to see some of that. And I know that most states are trying to look at how do they change zoning in order to add density. Robert, do I see residential spec building? Well, spec building is interesting. And when you look at new construction in aggregate, builders, they put on a planet to do one thing, that's build houses. But they've got a big problem. And they haven't had historically a land problem. But as I mentioned earlier, they're now looking further out where land is more available and cheaper. Labor costs continue to appreciate. No one wants to learn to become a plumber, carpenter, or electrician. That pushes up labor costs. But material costs, lumber prices are up year over year by 52%. That is ridiculous. What's going on there? Well, two things, one of which was forest fires mainly in California and in Oregon caused issues there. But in addition to that, we are actually putting a tariff on lumber being imported from Canada under the previous administration, the Canadian softwood lumber tariff. What do the Canadians ever do bad to us? Anyway, so we were taxing more of that lumber. So lumber prices rose. Copper, steel, aluminum prices, they rose. Why? Trade wars with China. So I think if we see some softening in hard costs, that is going to help. And I believe that builders, spec builders, absolutely. But the trouble is, if you look at it from their perspective, what they're going to do is they're going to look at the land cost, the cost to build, the material costs, and finally, regulatory fees. 25 cents of every dollar it costs to build a home are regulatory fees. So when you put all those things in a bucket, spin it around, it will spit out a price you have to sell the home for to make a margin. Well, if that price is $900,000, but the market price acceptance point in your area is $600,000, are you going to build it? No, you won't. Did you build it back in 2006? Of course you did, because you were spending all of the bank's money. Well, banks are being very cautious in their underwriting. You've got to have skin in the game, probably around 32, 33%. So builders are being cautious. Now, do I think that we are going to see more spec construction? Yeah, on a one-off basis, I think that we will. But there are obstacles to builders, mainly based upon cost.
Yep,
I think rising...
I didn't mean to cut the answer off. I was just going to say, we are right at our 1 hour. And
Oh, okay.
one
Last question then from Jessica. Will rising mortgage rates drive down the number of units sold or just drive down prices? They're not going to drive down prices, Jessica. They are going to slow price growth. Prices are not going to go backwards. They're just as mortgage rates rise. Remember I mentioned that 1 in 10 rule. For every 1 percentage point drop in mortgage rates, you can buy 10% more house. The same thing applies in reverse. So that's going to act as an obstacle. But in terms of driving lowering demand, we're still going to be an average this year in the low 3s. Jessica probably doesn't sound old enough, but in 1982, where were mortgage rates? 18% plus points, 20%. People still bought houses. So even getting above 3%, it's not going to hit demand, but it is going to act as a headwind to price appreciation. Prices, however, are not going backwards.
All right. Hey, Matthew, in the chat box, there's some people chatting in. Thank you to you once again. We enjoy having you here. It's become a neat annual event. This is our 4th annual forecast from you in Walla Walla, and we're all looking forward to next year. The plan is live again, you in Walla Walla, and we'll get you some of that good Walla Walla wine as well. So
I can't
thanks
wait.
Everybody for being here.
Yeah, thanks everyone for being here. I will, by the way, I will send the slides to Mindy and Doug later on this morning. They will share it out with all of you. In closing, take care of yourselves. Be safe. I know for the real estate brokers out there, keep on doing me a favor. Back off the hugging. I know you like to do that. Slow it down a bit longer. It's going to be important. And I do look forward to seeing all of your bright, shiny faces again in a year's time. Thanks, Doug.
All right. Thank you, everybody. Have a great rest of your day.